Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Tuesday the 21st of August 2018. I'm Darren Sinden and you can follow me throughout the day on Twitter by using @ds_Pepperstone. Right, let's take a look at overnight changes and price moves to be aware of. And it's been a story of dollar weakness overnight. Dollar index down to 95.49, down by 0.43% on the day. And the majors pushing back. Euro, sterling, the Aussie, the New Zealand dollar, all examples of currencies taking money off the dollar, as it were. And it's happened in the emerging markets too. The South African rand fighting back, down by 0.58% against the US currency in the last 24 hours. And we'll look at the reasons behind those moves a little bit later on in the video. Okay then, what's on the calendar? Events that may move the markets today. Relatively compact calendar, but we've already had Reserve Bank of Australia meeting minutes, and we'll look at those in a bit more detail momentarily, and credit card spending out of New Zealand for the month of July. The read there, 3.2%, slightly disappointing relative to the prior month's 5.8%. To come at 6 a.m. GMT, we'll have trade balance data out of Switzerland for the month of July. And then at 8:30, back in the UK, we'll have the public sector net borrowing requirement, if I can even say that, for the month of July. A look at the state of play of UK government finances. Fast forward to 10 a.m. GMT, and it's the turn of the CBI Industrial Trend Survey and new orders for the month of August. At 12:30, we'll see the release of Canadian wholesale sales for the month of June. And at 12:55, back to the USA for the Red Book Index for the month of August, or rather the week of August the 13th, I should say. Then there's a gap till 2030 when we'll see the release of the API weekly crude oil stocks from the USA. And finally, at 22:45, we'll have retail sales for the second quarter 2018 out of New Zealand. Okay then, breaking news and comment that's caught my eye overnight. And first of all, the US dollar has weakened after President Trump criticised Jerome Powell and the Federal Reserve at a fundraiser in the Hamptons. And Mr. Trump added that he would continue to trash him until he bent to his will. And that's not what the markets want to hear. The interference by the government in the role of an independent central bank is bound to upset the markets, and we've seen that in the way the dollar's reacted to that news. Meanwhile, FOMC member Bostic has said that the US economy is no longer in need of stimulus. However, trade is a key risk to the economy, and those comments are likely to annoy Mr. Trump further, one expects. Meanwhile, the Reserve Bank of Australia minutes show that the bank will not raise rates near term, and that it is concerned about trade and an ongoing drought in the country. So Australian interest rates not going anywhere in the near term, as we expected would be the case. Okay, food for thought, something to take away with you then into the trading day and beyond, and why not think about this? The US dollar surge looks to be over for now after President Trump's Fed comments, but possible problems in the emerging markets are not so transient. And the charts opposite track the growth of debt issuance in selected EMs since the global financial crisis in 2008, showing who may benefit from a continued dollar retracement or suffer from a rebound. And it's well worth having a look at these charts. The red areas show debt issuance in foreign currencies, and the blue areas show the issuance in local currencies. Of course, Brazil, Russia and China all stand out here, alongside Turkey, who's obviously had its problems, and India already. So let's take a look at the risk warning. Please take a moment to read this risk warning. Trading CFDs and foreign exchange on margin can be a risky business. If you're in any doubt about the suitability of these products for you or trading on margin, then please do contact your Pepperstone account representative. And as I say, please do take a moment to read this risk warning thoroughly. Thank you very much for your time.